CFC Seymour. He joins us now live from our Hong Kong studio. Dariusz, welcome to you. Now, clearly we do have two very important rate decisions due out this week, the Fed and from the BOJ. Let's start with the Fed. Now, you are expecting to see the Fed cut rates this week.
Exactly. We are in line with market consensus, calling for a 50 basis point decrease in the Fed funds rate target, which is totally justifiable given the very dismal data of late, as well as disinflationary trends in the economy. So the Fed has no choice but to try to stimulate the U.S. growth by lowering interest rate target. But at this point, level of the Fed funds rates doesn't matter that much to the economy, and therefore attention will focus on what kind of measures policymakers will take to bring down longer-term rates by either targeting money market rates of longer tenors than overnight, or purchasing larger quantities of mortgage-backed securities.
Given there are likely to be some of those other measures, Dariusz, that you've just mentioned, do you expect to see rates in the US at zero?
Well, it's kind of anyone's guess, but it doesn't really matter that much whether they bring rates exactly to zero or, as we expect, a quarter percentage point by January, because there's pretty much no difference for how much such 0 or 0.25 percentage rate will stimulate the economy. What matters more is the longer-term yields, especially on mortgages, that determine the costs of purchasing houses and demand. So markets don't care that much anymore about whether it will be zero or not. What we want to see is further non-conventional action by the Fed.
But in terms of the currency there, you do expect to see the greenback giving back some of the gains moving into 2009, even though we're expecting, or you're expecting rather, a recovery in the economy in the second quarter.
Exactly. In terms of the US dollar, it has been very strong so far in the second half of this year due to repatriation of capital into the US market as global equities were falling. We believe that US stocks hit the bottom on November the 20th and will no longer see such low levels, which removes much of the reason for repatriating capital there, because US investors will be simply more confident and willing to take more risks by putting money elsewhere. So the strength of the dollar is largely behind us, and as US stocks and later on global stocks recover further next year, there will be outflow on the financial investment side of the U.S. balance of payments, and this will pressure the greenback down versus most currencies except the yen, which will come under pressure later next year as global risk appetite recovers.
Now, the yen, this is a very, very interesting currency. A lot of speculation surrounding the yen right now. We did, of course, see the yen fall surge rather to a 13-year high against the dollar on Friday after that news on the US bailout package failing to pass through the Senate. A lot of speculation. We may see some government intervention here within this currency. Do you expect to see any sort of moves by the government to try and cap these gains?
I believe that Japanese policymakers will mostly resort to verbal intervention because I doubt that if the market trend continue to be upwards for the yen, intervention by Japan alone would make much of a difference. However, if we are correct that global equities will recover, I think that sentiment for the yen will improve. Another reason for such improvement would be that much of the strength recently came from the fact that global interest rates have converged towards zero among major economies, which removed much of the reason to sell the yen. Now that the process is drawing to an end, that reason will again be valid, as investors will be willing to invest outside of Japan to benefit from recovery in the riskier asset classes such as equities and commodities.
All right, Dariusz, thank you so much. Now, Dariusz, of course, is staying with us for another chat in just a couple of minutes from now. Strategist at CFC Seymour. He stays with us live from our Hong Kong studios. Dariusz, let me broaden the picture a bit to incorporate much of Asia. Now, you believe that many of these Asian countries will actually see contraction in GDP for the whole of 2009.
Exactly. Unfortunately, Asia as a region is likely to see some major economies performing worse than their European or Latin American counterparts due to the very heavy dependence on exports, which are going to suffer as demand from the developed world is going to slow. So countries such as Hong Kong and Singapore, dependent on external trade the most, as well as Taiwan, Korea and Japan, unfortunately will contract for the whole of 2009, and recession in these economies will not end until the US recovers and triggers enough demand for exports from these countries to pull out their economies and allow them to expand again.
Dariusz, what does this mean in terms of China and the significance of China in the region, and actually China turning into the world's second largest economy?
China is going to be the second fastest growing economy next year in the world. We are assuming 4.9% of GDP expansion. However, much of the growth will be satisfied by domestic demand. Chinese contribution to global growth will come mostly from a shrinking of their external surplus, so it's sort of a passive contribution. China itself, looking at the industrial output data, probably will see recession in Q4 and Q1, except that they do not release quarter-on-quarter results, so we will never be able to confirm whether this happens or not. But China will not save the world from the next recession in 2009.
How concerned are you then about deflation in China?
I am quite concerned. We believe that we will see deflation for most of next year, beginning in March at the latest, looking at the speed at which disinflation has proceeded so far. This is going to worry policymakers there and is going to trigger further rate cuts by the central bank. But I'm more concerned about slowdown of growth and how far investments are likely to slow in China, because if the government does not manage to stimulate private investment by their fiscal stimulus measures, then there is risk of an even deeper slowdown on growth in the world's second biggest economy.
All right, Dariusz, that is all we have time for. Thank you so much for joining us today.
Thank you for having me.